What's going on, everybody? This is going to be the last video of our mini course series. And in today's video, we're going to be looking at wrap, lease options, and the VA second tier loan calculator. Now, we're going to dive right into this, and we're going to start off with the VA loan calculator. Let's say, for example, you are working with a seller, and the seller happens to be a veteran. And let's say, for example, they are planning on buying another property in the near future. It may be valuable information as you, the agent, you, the investor, or you, the buyer, to provide this information up front so that the seller is aware of their second tier VA entitlement if you are taking the property subject to the existing loan. So, for example, if the veteran has an original loan with the VA for $300,000 and they told you they are planning on moving from Georgia to Texas, we can then come over to our conforming loan limit, and we can see that both Georgia and Texas share the same loan limits, and that loan limit is 76550. So we're going to plug that into this cell, 76550. This is the maximum conforming loan limit that the veteran can expect on a second tier entitlement. So that second property that the veteran is looking for, they can have two VA loans out at the exact same time. The first loan will be tied up with $75,000 worth of entitlement, and the second loan that they take out through the VA program will be tied up with $116,000 of VA entitlement, meaning that seller who's buying another property, they can qualify for up to $465,000 purchase price of a property at zero down to them. Pretty powerful stuff. Now, if they're going to be over in the New York region, along the East Coast, or on the West Coast like California, or certain areas of Colorado, then the entitlement is going to go up for them, and you will just adjust this cell here. But the majority of the nation is going to be centered at around the 766 conforming loan limit. So when you're having that conversation with the seller, it's just additional information to give the seller as positive feedback to them that yes, they can continue to use their veteran privileges and they can qualify for another purchase on another residential property up to $465,000, zero down to them. Now, if they happen to want a property that's more than that, let's say they're looking at a property that's $500,000, then they would simply have to make up the difference on the down payment that the VA loan program does not cover. In this case, the seller would have to bring $8,000 to the table to cover that remaining difference, which is honestly a really good deal. So now let's move on over to the wrap and lease calculators. That's going to be our main objective. I am currently in the middle of acquiring another property. It happens to be over in Georgia. And so what I'm going to do here is I'm going to do a live demonstration to you as to how to run your numbers according to a wrap exit and a lease option exit. We're going to be looking at both options here. So I have a property right now, and the property right now is sitting at about $340,000 market value. So I'm going to put in my market value of $340,000 in the first cell. To find out what the current market value is of the property, you can take a quick look through Zillow, you can take a quick look through Redfin, and then once you've done those two numbers, it would be a good idea for you to comp out the property through a proper comp and not just go based off of the estimates that you're seeing from these two service providers. Now, when I'm thinking about doing a wrap, I am going to up my purchase price. You have two options on a wrap. You can up the purchase price, you can up the interest rate, or you could do a combination of both. And if you're not familiar with a wraparound mortgage, it's essentially you are selling the property to a retail buyer on seller finance. And if none of this rings a bell, then I would do a quick YouTube video search and type in the words seller finance or wraparound mortgage for a better explanation. A good instructor to learn from would be by the name of Bill Bronchek. So I am going to have taking down a property very soon over in Georgia, and I'm going to resell that property on the open market to my retail buyer. I am going to ask for $350,000 purchase price on that property. Now, you can see here that these numbers here are adjusted. This 2.9 is saying that by me inflating my purchase price, I am nearly 3% over the current market value, which is fine. The way that the wrap is going to work is that we're going to incentivize a retail buyer who maybe can't qualify for a traditional loan mortgage. Perhaps their DTI is quite too high, or maybe they receive cash and don't have W-2 pay stubs. And so there will be people such as the blue collar folks who are looking for that single family residence and simply can't just walk into a Wells Fargo or Chase because they will not qualify on paper. So that is where we come in. We provide affordable housing to those who otherwise would not be able to qualify. And so in this example, when doing a wrap, normally my wraps for my down payments are going to be anywhere between 6 and 8% down. If I can get 10% down, that would be great. But they're typically they're going to be around 6 and 8% down. So I'm going to throw in a down payment that the retail buyer is going to bring to closing to acquire this property. We need to, you know what we could do? Let's rewind this real quick and let's adjust this to maybe 5%. There we go. That's a lot easier. So what we can do here is actually just go to column D, row 5, and just adjust the percentage here, and this will bring you your down payment. So we're going to say 8% down. So I think we could probably get about $28,000 from the retail buyer. I might even be a little pessimistic and say 25. So let's try 7% down. Okay, well, let's bring that up just a little bit. I'm going to try and target $25,000 down from the retail buyer. Okay, so we'll leave it there. This is what I am going to expect as my down payment for this property that I am going to seller finance to the retail buyer. Now we see a loan amount here for $324,000. Now what I need to do is move on over here to the right, and I need to plug in my variables for the existing loan balance as well as the seller finance loan balance. Once these two variables are filled out in these two boxes, we can then come back up to the top and finish off the rest. And you'll see why in just a sec. So I'm going to pull up my mortgage statement, the most recent mortgage statement that I have. That's not it. Okay. So I have a VA loan, an underwriting loan on the property, and the original loan balance on this VA loan is $310,971. So this number here is representing the original loan balance at the time that the seller took out the loan. In most cases, the seller had a purchase price of their own property that they were acquiring. They had put down a down payment, and then the remainder is the loan amount. And so in this case, my existing loan amount on a underlying mortgage that I will be taking over subject to, that loan amount is $310,971. Now, some mortgage statements will not have the loan amount that was originally issued. And so if you need to figure out what the loan amount is, simply figure out the number of payments that have been paid on that loan thus far. So let's say you know that there have been about 20 payments made on that loan, and you would simply look at the principal on the P&I of the mortgage. Let's say the principal portion of the P&I is maybe let's say $450 or $400. Principal is $400, and we know that the seller has made 20 payments up to this point. In order to find the loan amount, the original loan amount, we could then take the 400, multiply that by the number of payments made. So this would be the principal of the principal and interest of the PITI. This is the principal. Number of payments made by the seller thus far, which is $8,000. You would then add the $8,000 to the current remaining principal balance, and that will bring you up to the loan amount. And you would do this method if the loan amount is not originally stated on the mortgage statement. If it is, you don't have to go through that math. Now, I've got an interest rate on this underlying loan at 2.99%. My principal and interest combined on this loan, according to the mortgage statement, is going to be $1,309.39. And the number of months that this property has been paid thus far is 30 months, meaning that when the loan was originally taken out, the seller has made 30 months of payments on this loan up to this point, which just happens to be December 16th. As of the recording of this video. Now, I am also going to have a second note on this property. So whether you're taking a property subject to or seller finance, one of these variables, if not both, are going to have to get filled out. In my example, the property that's being acquired is a hybrid deal, and so I will be filling out both of these. If you only have one underlying note, then you would just fill out the existing note that's on the property right now. If you are creating a note with the seller, then you would use this box here, which we are going to fill out now. And if you have both, then you would include both. And so I have both. And so my seller carryback to the seller, because they are not receiving all their equity up front, the seller carryback is going to be $37,000. We have agreed to a 1.74% interest rate on that loan amount. My monthly payment to them, principal and interest, is going to be $132 to them every single month until the balloon period is paid. In this case, my balloon period for this remaining seller equity is going to be 36 months. And so there will be 36 months paid on this note. And at the end of the balloon, I will owe the seller $34,106 at the end of the 36-month term. Now, we're going to go up to where we were before, and then once we're done on the left-hand portion up here, we'll then come back to the right-hand side. What we need to take a quick look at before we move up to the original left-hand side of the screen is double-check the loan amount here. We see a loan amount here of $310, and we see a seller finance amount for $37,000. So a good principle to follow is to then combine these two monthly payments of $310,971. We will add that to the underlying loan balance of $37,000. This would mean that my loan amount with the retail buyer cannot be less than $347. So I'm going to now go up to the left-hand side of this calculator and adjust my numbers accordingly to, let's say that the loan amount remaining from the retail buyer is going to be $350. And so let's do that now, because right now we're at $324. So this needs to be closer to the $350 mark. So what we can do is come up on the purchase price. We're only at 2.9% over market value at this moment in time. Let's bump this up to, let's say, $360. And let's say we agree to 20. We're going to have to adjust this. We're going to have to adjust this greatly. We've got we need to adjust this by about $15K. We want to get this loan amount higher than the $347, and you'll see why in a sec. So the purchase price right now is $360. Let's bump this up a little bit more. I'm not going to go past the 10% market value. That will be my cutoff. Okay, so 374 is probably going to be the highest that I can go on the purchase price. So what I'm doing here is I'm going to inflate my purchase price with the retail buyer on paper, because we are trying to get this loan amount to be equal to or greater than the total loan amount that's going to be remaining on this property. So let's now, what we can do is actually do $25,000 down instead of the 26. So let's bring up that down payment to 25,000. You'll see why I'm doing what I'm doing in a second. I'm going to be doing this live for you. So the down payment that I am going to request is $25,000 down. Our total remaining balance right now on this property that's being a hybrid, we've got one note at $310,000. We've got another note on the property for $37,000, which means we have a total debt on the property for $347,000. I want to create a new debt on the property that is equal to or greater than this debt, because $348,942 minus $347,971 will be my buffer, so to speak, not my spread, but my buffer when the property is either sold or refinanced by the retail buyer. We are selling this property on a wrap, and when you sell these properties on a wrap, the owner of the property is the retail buyer, and so they have full authority to sell the property or refinance you out at any point in time. Now, you can always create an incentive with the seller that if you stay X amount of years, maybe we'll drop down the interest rate or we'll adjust the monthly payment. You can get creative in that sense. You can throw in a pre-penalty if they were to do that. But what we are trying to do is cover our loss. So we've got old debts here for $347,900. Let's just say $348,000. And we're going to have some new debt here created by the retail buyer for almost $349,000. So we can leave it there. Just remember that the loan amount that the retail buyer is going to be responsible for must be equal to or greater than these two loan amounts combined. That is the rule of thumb. So now I'm going to adjust my interest rate to, let's say, maybe 5%. And we can see that we've got some auto-populated figures. We're not quite done yet. We're going to fill out this right-hand portion of the column here. And I'm going to throw in the current interest rate on my underlining sub-2 that I'll be taking over. So it'll be 2.99%. There is a current P&I for 1309.39. There is an HOA on this property, so we're going to include that. It's 105. The seller is going to get a monthly payment of $132, which is noted down here for the seller carryback. So we'll plug that here. There is no mortgage insurance. However, if you're working with an FHA loan, all FHA loans require mortgage insurance, so beware of that. And in most cases, it's non-negotiable and you can't take that out. So the total payment that I am going to be responsible for as the lender in this case, because I'm no longer a landlord, I am going to become the bank on a wrap. And being that I am the bank, the total payment that I am going to be responsible for is the current principal and interest, the monthly payment to the seller on the seller carryback, plus the mortgage insurance. So this is going to be my monthly payment that I am responsible for. Now, the retail buyer then is going to come over here, and we're going to net the difference between the principal and interest that we are charging them. Now, before we start messing around with the interest rate here, I'm going to fill in the escrow balance. The escrow balance in this case is going to be the taxes and the insurance on the current mortgage statement that I have at this moment in time. And the escrow balance in this case on that property, the taxes and insurance, is going to be $418.40, and the taxes and insurance is going to be covered by the retail buyer. Remember, they are becoming the new owner of the property. You wrapping the property, you are essentially doing a seller finance. You are creating a new note out of thin air. You're giving ownership to the property, and you, the investor, are now becoming the bank as opposed to the landlord. Okay, so now we need to adjust our interest rate. I am going to be pessimistic here for the sake of example. Right now, interest rates are sitting at 7.75 to 8.25% interest rates. In fact, maybe I can pull that up for you really quickly, as it doesn't take too much time to do. Let me refresh my page here for December 16th, and we could take a look. You know what? It actually came down quite significantly, which is actually good news for retail buyers. So you'll actually want to take this into account as well when you're doing your math. So on a 30-year fixed conventional mortgage, as of December 16th, mortgage rates have come down. APR right now is at 7.2. There is a possibility, as the Fed has been discussing this, and we could be looking at 3 more rate hike declines in the coming year for 2024, meaning that the 7.2 can now come down to maybe closer to 6.5, but we shall see. So keeping in mind of the current mortgage rates, my interest rate that I am charging the retail buyer is going to be the sell rate. This is the sell rate that the retail buyer is going to be purchasing this new note from, and my buy rate is the existing note interest rate that I have acquired through the original seller. So this is your buy rate, and this is your sell rate. This concept is done through the financial systems, through the car dealership. So anytime you are sitting in the back office with the head honcho himself, the finance guy, and you are about to lease or finance your vehicle, keep in mind that the car dealership is charging you a sell rate on the interest rate when you are financing a vehicle, and they are buying that same rate from the lenders that they are working with, and they are keeping the spread. And we are essentially doing the exact same thing. Now, we can see here at the very bottom that the wrap PITI to the retail buyer is going to be almost $2,400 a month. Now, the $2,400 a month is going to take into account of the original principal and interest, which is the note that you are creating, plus the HOA, which in this case we do have an HOA, plus the taxes and the insurance that the retail buyer is going to be responsible for. In this case, they are going to make a payment of $2,400. You have a payment responsibility of $1,441, and now you get to net every single month $536 every single month. This is your net in your pocket. Now, if we're coming to closing with $35,000, which happens to be the exact amount, ironically, that I am coming to closing with, I am getting 72% of my down payment back to me. I'm going to request $25,000, and of that $25,000, I am getting 72% of it back because I came to closing with $35,000. Now, at a 5% interest rate, this is pretty reasonable. I was taking a quick look over at the long-term rentals in terms of what they are charging, and the traditional LTR in that region is going to be between $2,400 and $2,600 a month. So with $2,400 being the total payment that the wrap retail buyer is going to be responsible for, I can come up on my interest rate and bump up the amount of the payment that the retail buyer is going to be responsible for up to $2,600, because that is going to be the median range of the rental prices in my particular area on that property. So let's adjust this, and we're going to say maybe 6%, and that might actually be our cutoff here. So we went from $2,400 to now $2,600 that the retail buyer is going to be responsible for. This 6% is still much less than today's current interest rates at the 7.25, I believe. It did come down. And so now my monthly net is going to be $755 a month. Now let's take a quick look at how this plays out at the time of inception. The time of inception, meaning when the retail buyer decides to sell the property out completely or refinance you out. Now remember, they would be refinancing you out based off of the note that you created with them. You created a note with them for a purchase price of $374. You created a loan which has a loan amount now of $348. The loan amount must be equal to or greater than these two loan amounts combined. You need to be able, you don't want to have your new loan amount with the retail buyer that is less than the existing debt on the property. That would not work out for you. You would be in deep waters. So at a 3-year mark for inception, I, the investor, will have a sale payout if I were to sell the property, or not me, I'm not selling the property. The retail buyer, if they were to sell it or refinance me out, I could be looking at anywhere between maybe $25,000 and $28,000 on the sale payout, with a total return of about $55,000 in 3 years. Now I'm going to adjust this because I have the ability to adjust this. Let's look at the 12-month mark, which would be 1 year. And at a 12-month mark, we can see that this property here will indeed cash flow. It will cash flow, and I will not be in negative waters because my sale payout is going to be $21,000 should the retail buyer sell it or refinance within a year. Is the likelihood of that happening great? Probably not, but it could happen. Now, if my wrap seller finance amount was less than the total loan amount on here, then these two numbers here would be negative for the first 12 months, and they would show up as bright red. We can see here that the sale payout is taking the created note, subtracting it from the sub-2 balance, subtracting that then from the original owner finance balance after the 12-month inception. So this would be your sale payout. I'm going to take a quick screenshot of this just so we have a point of reference, because what I'm going to do now is I'm going to adjust the loan amount here at the $348. We're going to adjust this so that the $348 is going to be, we're going to adjust the loan amount that it's going to be less than. So by creating a loan amount that's less, we're going to increase the down payment. Maybe let's do 8%. Let's try 10%. 336. Now let's look at these numbers here. We can see a pretty big difference on the sale payout. Now, in this example, we are not in the negative range, but it is good practice to combine both loan amounts. In this example, we happen to be lucky, and I think it has mostly to do with our monthly payment of $681 being higher. This is quite a high monthly net payment, which is a good thing. So let's go back into here for the wrap profit inception. And let's readjust this to what we originally had. So the 340, no, let's go back one more time. Okay, that is what we had originally. We can now adjust the months after inception to kind of have an idea of what we can expect in terms of profit. So at 1 year mark, we're looking at about $21,000 sell payout with a total return of $30,000. In 2 years, that would be our sale payout and total return. At the 60-month inception, which would be 5 years, that would be our sale payout and total return. So you can see that this deal is going to make me some money. And so these numbers are good. These are the types of properties that work really well on a wrap. The lower the interest rate, the bigger the monthly net spread. And if the principal balance has been paid out quite a bit, then in this case, we actually have a balance remaining of $294, then we are going to make some money here. And what we could do, actually, you don't necessarily have to go based off of the loan amount. What you could do is let's rework these numbers again, because there is another way to do wraps, and it's good to know both ways. Because this was the original loan amount on the existing loan, and they've already paid it down 30 months, we could just go based off of the remaining balance that's on that loan. In this case, there is a remaining balance of $294 as it's already been paid down. So what we could do is, to make this a little bit easier on the retail buyer, is we could take $294, $341, plus the seller carryback of $37,000. And now the seller finance note that I am creating must be equal to or greater than $331. So let's do that, because we could probably come down on the purchase price even more. We don't need to go all the way up to 10%. I want to sell this deal. I don't want to be sitting around for 60, 90 days to find a retail buyer. So as long as my loan amount remaining that I'm creating the note is higher than this would be your minimum. The minimum would be the balance remaining on the existing loan plus the actual loan amount with the seller carryback, because this has not been paid yet. You haven't made any payments to it yet. You've created the note, and you will be making your first payment to the seller on day one after closing, right? So that's why you're taking the loan amount here on the seller finance side as opposed to the balance remaining, because you haven't made any payment to begin with. But let's go back over here and let's adjust the loan amount here. So I want to see if I can get a bigger down payment. And in order to get a bigger down payment, let's see if I can adjust this to 10% down at $30,000. Let's bring down our purchase price. Okay, the loan amount here is $333. Let's bring it down a little bit more. Let's go to $365. Okay, now we're in negative territory. I don't want to be at $328 because it's going to be below the $331. So we don't want that. We can see how close we are right now to the sale payout. So that is what I was referring to before. So we can go based off of the minimum, but keep in mind that you want to have a buffer between the existing debt on the property and the new debt that you are creating with the retail buyer. So I don't like that, because that sale payout is very little. So we need to bump up the loan amount here from $328 over the $331. So let's try and target a loan amount of $335. So we've got a greater buffer here. So we can reduce the down payment. Let's try 9%. Let's go down to maybe 8.5. I want to try and target a down payment of $30,000. We can come up a little bit more. Okay, perfect. So at $334 loan amount, this is going to be, the new debt created is higher than the original debt on the property. If we take a look at the sale payout, I am in green territory. And we were speaking that the wrap portion of the retail side, the LTR was going to be between $2,400 and $2,600. So I can actually increase this interest rate a little bit more so that we are receiving $2,600 from the retail side. So let's bump this up to, say, 6.2%. Let's go a little bit more, 6.3. Let's try 6.32. Okay, perfect. So we can see how that's also affected our monthly net on here. So now my return is going to be even greater by just doing a simple adjustment with our numbers. Now I'm looking at an 86% return on my down payment, because the down payment that I will be receiving from the retail side is going to be $30,000. And my monthly net is going to be $741 every single month to me. Now let's go back to the wrap time at inception. At the 1 year mark, these are the return values that I can expect at 2 years and at 60 years. Let's look at the 3 year mark just for example as well. So we've got 1 year, 3 years, and 5 years. So pretty solid deal here. I'm pretty happy with it. These are probably going to be the numbers that I'm going to base off my wrap calculations. And now let's move on forward to the lease option. Now with the lease option, it's going to be much different. I cannot charge the same amount of down payment with the lease option. I would be lucky if I can get maybe $15,000 on a lease option. So I'm going to go based off of that purchase price of $365,000. I think that was a good number to kind of stick with at $365,000. And I'm going to try and target about half of that down payment. So let's lower our percentage here to $15,000 down. So we would be looking at maybe 3.8, 3.9, all right, maybe 3.85% down. Okay, good enough. So on a lease option, the option fee that's being taken by the investor, this money is going to be non-refundable to the investor. So this would be the option fee. Non-refundable, and it will also go towards the option price at the end of the term agreement should the retail buyer want to execute the lease option to purchase the property. But on this option fee, I'm going to be looking at about $14,000 as my down payment. Now let's go through the right-hand side of these calculations. My current PITI on this property is indeed $1,727,794. The HOA is $105. My monthly to the seller is $132, and so my total payment responsible on this property is going to be $1,964 and some change. So my rent needs to be much higher than the total payment that I am responsible for. So we know what the projections are for the long-term rentals. So let's start off at $2,400 rent with maybe an option fee of $100. The option fee is a monthly credit that is going towards the option price as well. Now, at $2,400 rent, I am not going to be really able to cash flow, so I'm really going to be looking closer to $2,600 a month for the rent. So if we include our repair reserves of 10%, lease options typically mean that the investor in this case, since you still own the property, you will be responsible for the major hiccups that could occur on the property, such as maybe a furnace is out or the roof is leaking. So you want to put some money aside on your repair reserves. With the wrap, you are not the landlord, but the bank. But with a lease option, you are a landlord, but your responsibility of repairs is going to be far less. So now I'm looking at a monthly net of about $375 and some change. My cash on cash return in this case would be about 21%, which is really good. How the cash on cash return is being calculated is that it's taking the down payment that I'm coming to closing with, subtracting it from the option fee that I am receiving, and that is going to get divided out from the yearly net that I am going to earn on this property. So the next thing that we could do is look at the Redfin market trend data on this property that I have an interest in. So I am going to pull that up. Let's see if I can pull it up relatively quickly. I did have it open here on a window. Bear with me as I find it. I believe it's this one. Okay, here it is. So I have the zip code. And the zip code for this property is going to be 30047. We'll put that in right in the URL address for Redfin. And we're going to take a look at how the market trend is in that area. And let's look at the 5-year mark. So Redfin and Zillow, they're going to be running 2 months behind real world market data. So we'd be looking at the month of October's data, but we are in the month of December right now as of the recording of this video. So again, Redfin and Zillow, their market trends are behind, which is expected. But if we were simply to go based off of the market trend, we could then adjust our projected year-over-year growth. So what I'm going to do is I am going to reset these values here on the right-hand side. And we're going to do this together. And so I want to be looking at the month of October. And for the month of October, I can see a year-over-year growth of 6.7%. So I am going to include that. So let's put in 6.7%. Let's move on over to October of 2022. We could be pulling from December's data, but we want to see if we can pull off of 5 data points. Having 5 data points is going to be far better in terms of a statistical agreement. So let's look at October. There was a year-over-year growth on this particular zip code of 16.4%. Now, mind you, these values they're contingent on many anomalies, but it is a good point of reference just to get an idea of how good of the growth is in this area. And just based off of the graph alone, we can see that we've got a pretty good market trend. Year-over-year growth for October 2021 is 19.6. As for the last 2 variables, for the sake of time, I'm just going to pull that up on my left-hand screen here and see what that would be. For October 2020, we're looking at 12%. And for October 2019, we're looking at a year-over-year of 6.6. So that means our average year-over-year that we can expect is going to be 12.3. We're going to come over here and check our math here. Looks like there is an outlier, which is why I am looking at the data set in a particular way. We're looking at the standard deviation and the confidence interval. I can see that this point here, the 19.6, is above the upper bound limit of 16.43. And so that is why the outlier is reporting as true. Now, in terms of the lower bound, I don't see any values here that are lower than the 4.96, but the 19.6 is an outlier. So in order to compensate for that, we are going to delete the 19.6. And now our upper bound has been affected by it. Looks like the upper bound limit is 14.93. And we've got an upper bound limit here of 16.4. We're going to have to delete that as well. The upper bound limit on this one is going to be 12.63. We're at the 12% mark. I am going to leave this as is. If this was 13 or 14%, then I would have to delete these 2 variables, delete the third variable here and just go based off of the 6.6 and 6.7 year-over-year growth. But in this case, I think we're pretty close here that we don't have to exclude it. So overall, the market appreciation on this zip code, we'd be looking at about 8% year-over-year market appreciation. Now, the average appreciation statewide across the U.S. is 5%. So we can see here that we're actually going to be relatively close. 5% being the typical average or the typical minimum. If we were to adjust our average appreciation to 8% and we were to add, let's say, 5% sweat equity to the property, after 3 years, we could be looking at a market value of $411 compared to its current market value of $340. And so when we are executing these options to buy that the retail buyer can execute, depending on the executed option, whether it's a 2-year option, whether it's a 3-year option, or a 5-year option, it's going to affect the option price. So for example, the 2-year option, we're estimating that the property value is going to be $384, but with the option credit of $100, the executed option is going to be $381. And so this would be the amount of money that would be either cash or conventional loan, and they would be paying you, the investor, a $381 executed option price on year number 2. You would have a net payment from the proceeds. You would have a net payment over the next 2 years. The net payment would be coming off of the $375. Your payout would be that of the executed sales price. So that would be your executed sale price. If you take a look at the formula here, we are taking into account of the underlying encumbrances that are on this property. So we're taking into account that there is a subject to transaction being involved that's being taken over on those monthly payments, and we've got a seller carryback that's also being taken over. So we can expect a payout of about $66,000 after the 2-year mark, should they choose to sell the property, or not to sell the property, we're not doing it out, should they want to execute the option to buy. Now, the executing of the option to buy is going to be based off of the future value. Do not have the executed option price of today's current market value. It must be roughly the executed option price. Now, recall, this is based off of an 8% average appreciation according to the Redfin market statistical analysis that was done. If we just go based off of a 5% appreciation, then the executed option price is going to come down. So one of two things is going to happen. Either the seller pays more to you on the executed option price than what the current market value is in 2 years. So let's say the market value is less than $374. Let's say the market value in 2 years is $365, but you have an executed option price of $371. You would receive more money at the time of inception that they choose to execute the option than this future market value. So you'd be making a difference there. However, if the market value were to somehow skyrocket and climb to, let's say, maybe $390 in 2 years, and you had an executed option price of the $370, then you would be losing money. You'd be losing about $20,000 because the market value had increased higher than you had anticipated. Now, that rarely happens, and we are taking into account a very conservative estimate of what our expected home appreciation is going to be. And so with that being said, it's unlikely to happen that you will lose out on any equity that could have been obtained through the executed option. In this case, it's more likely that you are going to get a higher price up front. And because you're locking it in with the lease option buyer at $371, you're either going to be equal to or greater than the market value at the time of the 2-year mark. And so lease options are another great way for our exit strategies. So this concludes our last video for this mini course series. I hope this was helpful. I hope you now have a good idea of what a wrap exit strategy is versus a lease option strategy is, and how we can calculate this in this Excel CRM calculator. Thank you for watching, and we will talk soon. Take care.